Well, let's just actually get to more on the markets here. We'll bring in Keith Lerner, Truist Wealth's Chief Investment Officer. Keith, good to see you here. I mean, obviously, we've been in this mode all month where the market is obviously registering the pressure from higher oil, higher interest rates, and maybe a little bit of a growth slowdown, but really been grudging in its declines. Are we oversold yet? How are you tactically thinking about this market?
Yeah, well, great to be with you. I think, Mike, the way you characterized it before, as far as the market being confused, is probably the right analogy right now. So listen, I still think that this bull market, or the weight of the evidence in our work, still suggests the bull market does deserve the benefit of the doubt. But because it's been so orderly, our indicators are moving, towards oversold. Kind of mentioned this before. The percentage of bears in the AAII is at 52%. We're seeing put-to-call ratios move up. Actually, a lot of selling in the Spiders ETF. So you're getting there, but you haven't had a flush out. Obviously, you don't always get that. But I would even tell you that anecdotally, as I'm traveling, talking with advisors and clients, there's really not that much time. So I think ultimately we still likely have a bit more to go. Ultimately, we think it will be a buying opportunity. But at this point, we still think it's more of a mixed risk reward on a short-term basis.
There's a lot of commentary about, on a month-to-date basis, since the hostility started, the S&P's down, I guess now right around 5%. It's down like 6% from all-time highs. That doesn't seem like enough maybe to account for all that's gone on. On the other hand, we're at levels we first reached over 6 months ago in the S&P 500. The median stock in the S&P is like 16% off of its 52-week high. And arguably, if stocks kept pace with earnings growth, the S&P would be like at 7,200, right? So I just think it's interesting to try to do the counterfactual of where we would have been otherwise.
Yeah, that's a good point. And maybe one good point to what you're bringing up is we didn't go into this, at least at the S&P 500 level, really extended. We've been moving sideways since tech peaked in October. And really where you saw more damage, where you're down 7, 8, 9% is small caps and mid caps, or even some of the areas that just had really moved up quite a bit ahead of this. I will say the other thing, as we're going through this, I mean, the things that we talked about today, maybe a little bit slower economic growth, maybe the Fed is on hold for longer, maybe a little bit higher oil prices for longer. I do think that really upends, to some extent, kind of this broadening trade that everyone was leaning into right now, and even small caps. I mean, at this point, we're still maintaining some exposure there, but we also at this point think that maybe tech will eventually come back alive here, given some of the uncertainties, and they've repriced by about 30% from the highs, as far as the valuation.
Right.
Some of the worst performing sectors this week: consumer staples at the bottom of the pack this week, down, I think, 4% as a group, and healthcare. I mean, these are defensive places that you would go if the market was really worried about growth. So do you think that is mispriced, underpriced?
Well, I think in some ways, even like consumer staples, we have to remember they were up double digits ahead of time. Same thing with gold. Gold had such a big move ahead of this. So that's what's somewhat confusing. But on the same token, I think what's happened is some of these areas that tend to be more defensive had big run-ups ahead of this and aren't acting that same way. And then also something like staples, there's probably some concerns around just the inflation impact and the ability to push those costs higher, especially if we have an economy that is 1 foot on the gas, 1 foot on the brake right now. And as all these expectations as far as an uptick have now receded for the economy, at least in the near term.
And we were just obviously talking about a pretty complex interplay of growth and inflation when it comes to what the Fed is going to do. What are your expectations now? And I guess, do you think the economy can withstand a sort of wait-and-see Fed along with oil doing what it's doing?
Yeah, our house view is still 2 rate cuts by the end of the year. Obviously, when the chairman of the Fed says, hey, our forecasts right now are somewhat useless, when the Fed chairman says that, you also have to say it does depend on what happens with oil in the near term. But I think ultimately, to your other question, I think the market can withstand the Fed on the sidelines. I think the other thing, as you kind of step back, I mean, our companies in this economy has been battle tested, right? Think about COVID, the fastest rate hikes we've seen since the 80s, the highest inflation since the 70s. Our companies have adapted. It does slow things down, but I still think the economy and markets ultimately still earn that benefit of the doubt. But I think it's going to be a bit of a slog here, and we're all watching the same thing. What are oil prices doing, and what is the 10-year doing to really help? What we really need is stability in those areas for the market to regain its footing.
Yeah, for sure. I mean, hints of that, though we do have the S&P off about 0.75%. Keith, thanks very much. Talk to you again soon.
Thanks.